September 26, 2025. The Shanghai Gold Exchange released an update that barely made headlines, but it should have caught the attention of anyone watching the silver market closely. Silver margin requirements were raised to 19%. Not a small adjustment, a sharp move, a 17% increase. And this wasn't an isolated decision. It was the sixth margin hike of the year, 6 times in 1 year. That's not routine risk management. That's an exchange reacting to stress it doesn't want turning into a public problem. While most financial coverage focused on whether silver was trading at $60 or $63 an ounce that day, the real story was unfolding beneath the price chart. The physical market was tightening, and Shanghai wasn't trying to protect traders. It was trying to protect the system from a delivery situation it may not be able to handle. Margin increases like this don't happen because prices are rising. They happen when exchanges start worrying about what happens if too many people ask for the metal instead of the contract. To understand why this matters, you have to look at what led up to it. In early September 2025, silver was trading in the mid-40s. Then interest rates were cut. Capital moved into hard assets. Silver moved fast. And leveraged positions started building on top of a physical market that wasn't expanding. Futures trading allows control of large amounts of silver with relatively little capital. When margins are low, leverage is high. Exchanges normally keep silver margins in the low teens. That's standard. But when margins rise to 19%, leverage collapses. Speculation becomes expensive. Rolling contracts becomes preferable to standing for delivery. That's the point. High margins discourage delivery. They reduce the risk of too many claims chasing too little metal. What makes this situation different is frequency. This wasn't the first margin increase of the year. By early September, margins had already been raised to 16%, then 17%, then 19% within weeks. That's escalation, not adjustment, and it wasn't limited to one exchange. In October 2025, the Shanghai Futures Exchange also raised silver margins and widened daily price limits. Translation: price movement had become too aggressive for normal trading rules to contain. When multiple exchanges in the same market start tightening conditions simultaneously, it's usually because something deeper is happening. And what they were seeing was this: physical silver inventories were shrinking, while paper exposure kept growing. Warehouse data made that clear. By December 2025, Shanghai reported roughly 820 tons of silver in storage. In 2021, that number was over 3,000 tons. Inventory levels had dropped by nearly 3/4 in 4 years. That's not a healthy buffer. At the same time, trading volume surged to multi-year highs. Everyone wanted exposure, but the metal backing those contracts wasn't keeping pace. High paper volume sitting on top of declining physical supply is the classic setup for delivery stress. This wasn't confined to China. In October 2025, physical silver premiums across Asia spiked dramatically. Instead of the usual 50 cents to $2 over spot, buyers were paying premiums as high as $8 per ounce just to secure metal. That's not a pricing anomaly. That's desperation. When premiums reach those levels, arbitrage kicks in. Metal gets flown in from London and New York, except London wasn't flush with silver either. Reports at the time indicated that available silver in London vaults was already dangerously thin. Add in seasonal demand from India, rising industrial consumption, and strategic stockpiling, and the picture becomes clear. The entire physical supply chain was being pulled from multiple directions at once. This aligns with longer-term data. Industry projections showed a silver supply deficit of roughly 187 million ounces for 2025. That marked the 5th consecutive year where global consumption exceeded production. Over that period, nearly 800 million ounces were drawn down from above-ground stockpiles. Mining wasn't catching up. Silver production had declined since the mid-2010s, largely because most silver is produced as a byproduct of other metals. When base metal mining slows, silver supply follows. New mines take a decade or more to bring online. Supply is inelastic. Demand isn't. Solar installations, electric vehicles, data centers, and communication infrastructure continue to expand. None of these systems function without silver. This isn't optional demand. It's structural. This is why Shanghai's margin hikes matter. Exchanges care about one thing above all else: Can they deliver metal if contract holders demand it? Raising margins is a way to reduce that risk. Make leverage expensive. Encourage cash settlement. Delay delivery pressure, but that only works if shortages are temporary. By December 2025, silver spot prices were trading near $64 an ounce. On paper, physical metal told a different story. Large orders faced delays. Premiums widened. Availability shrank. Paper and physical prices began separating. That happens when paper claims vastly outnumber physical supply. As long as confidence holds, the system functions. When confidence cracks, contracts turn into competition for real metal. Exchanges can raise margins. They can change rules. They can restrict positions. But none of that creates silver. If industrial users start demanding delivery to keep operations running, and investors follow, the pressure compounds. Either contracts are settled in cash, damaging confidence, or metal is sourced at any price. Neither outcome preserves the status quo. This isn't about predicting tomorrow. It's about recognizing stress patterns. Multiple margin hikes, inventory drawdowns, exploding premiums, structural deficits. These are measurable signals, and unlike past squeezes, this one isn't driven by a handful of speculators. It's driven by real demand from systems that didn't exist decades ago. Solar, EVs, data infrastructure, AI. These are not luxury goods. They're foundational. In late 2025, the United States classified silver as a critical mineral. That decision wasn't symbolic. Governments don't label materials critical unless supply is at risk. That classification encouraged precautionary stockpiling and further tightened availability. This is the Shanghai situation in full context, not a single event. A convergence, structural deficits, industrial demand, strategic accumulation, fragmented supply chains, declining inventories. The margin hikes are a warning, not a solution. Based on inventory burn rates and delivery stress, the timeline isn't measured in decades. It's measured in months. Somewhere between stabilization and breakage. The system has to adjust, and when it does, it won't happen quietly. This isn't about fear. It's about understanding how markets behave when physical reality catches up with paper structures. That's what we examine here at Legacy of Money, the moments where history, policy, and supply intersect before prices fully reflect what's already happening underneath.